You're bleeding thousands of dollars right now, and you don't even know it, because the financial system is set up to keep you blind. If you're over 45 and sitting on $300,000 or more in a basic fund, your wealth is being quietly, systematically dismantled before your eyes. Today, you'll discover how the wealthiest 1% legally structure an estimated $120,000 transition to completely wipe out their upcoming tax bill. It's a precise institutional strategy designed to maximize your retirement balance before the upcoming EOFY deadline hits. But remember, this is general information only and does not constitute personal financial, taxation, or legal advice. You've to stay ahead of the game because the government won't do it for you. Let's look at how the top earners navigate the complex maze of the ATO guidelines. Most everyday Australians rely on their default setups inside massive industry funds or expensive retail funds. They assume their employers are doing the heavy lifting by making standard contributions. That's a massive, multi-thousand-dollar mistake that'll cost you your independence. High net worth individuals don't just accept default settings, they use aggressive concessional contributions to slash their taxable income to the absolute bone. For the current financial year, the standard concessional cap is strictly set at $30,000. This means you can funnel up to $30,000 before tax into your fund and watch it grow in a low-tax environment. If you're earning a high salary, every single dollar you earn above the threshold is taxed at a brutal marginal rate of up to 45%. But when you shift that money into your super through a pre-tax mechanism, it's only taxed at 15% inside the fund. That's an immediate, massive tax saving that remains in your pocket instead of going directly to the government. Think about an executive named David who found himself facing a massive tax bill this year. David was trapped in the highest tax bracket, giving away nearly half of his hard-earned bonuses to the taxman. He decided to implement a disciplined salary sacrifice plan with his corporate employer. Instead of taking his full cash bonus, he instructed his payroll department to redirect $20,000 directly into his chosen fund. By doing this, David instantly lowered his personal taxable income by that exact amount. The cash went straight into his retirement account where it can compound over the long term. It's a completely legal, highly effective technique that thousands of Australians miss because they're simply too busy to check their payroll portals. If you aren't maximizing your salary sacrifice options right now, you're actively choosing to give the tax office a tip they definitely don't deserve. You've to take control of these mechanisms before the fast-approaching end of the financial year cuts off your options completely. Furthermore, you must look closely at your carry-forward provisions if your balance permits it. If your total super balance was below $500,000 on the 30th of June of the previous financial year, you can access unused caps from the past 5 years. This can allow an estimated massive top-up beyond the standard limits. You can effectively inject multiple years of caps all at once. This allows high earners to wipe out massive capital gains tax events completely. It's exactly how the top 1% remain wealthy while others pay full marginal rates. Stop right there. Look at your current balance right now. Are you actually confident your fund is performing, or are you terrified of the upcoming tax season? Drop a comment below right now and tell me your exact financial pain point. Let's expose what's really holding your wealth back. Now, let's dive deeper into the deep corporate mechanics that the wealthy utilize to stay ahead. When your income exceeds $250,000, you enter the danger zone known as Division 293 tax. The ATO will hit you with an additional 15% tax on your concessional contributions. It's a painful penalty that catches high earners completely off guard every single year. But here's the secret weapon the top 1% use to mitigate this blow. They carefully balance their taxable earnings by maximizing deductions outside of to drag their total income back below that critical threshold. They look at every available avenue to ensure they aren't pushed into higher compliance brackets. If you manage this improperly, you'll find yourself receiving an unexpected debt notice from the tax office months after you file your return. Let's address the structural differences between industry funds and retail funds, because this choice alone can dictate your financial trajectory. Retail funds are often riddled with layered institutional fees and complex structures that quietly erode your growth over decades. On the other hand, large industry funds offer scale but often leave members stuck in conservative default investment options that underperform the broader market. The wealthy don't stay in default allocations. They actively choose high-growth or direct investment options within their funds to mirror the global markets. They ensure every single dollar is working at maximum efficiency. But none of this matters if you fall straight into the BPA death trap during the final week of June. This is the single biggest disaster that destroys tax strategies for unsuspecting Australians every year. People assume that if they make a BPAY payment to their fund on the 29th of June, it counts for that financial year. It absolutely does not. The ATO rules state that contributions are only counted when they're actually received by the fund, not when you initiate the transfer. If your bank takes 3 days to clear the transaction, your money lands in July. Your deduction is completely ruined for the year, and you've wasted your cap. It's a brutal trap that leaves high earners furious when their tax return is processed. To avoid this tragedy, you must ensure all electronic fund transfers are fully processed and confirmed by your fund well before the final countdown. Never leave your wealth hanging on standard bank processing's delays during the busiest financial week of the year. Remember, general information only and does not constitute personal financial, taxation, or legal advice. You've to act with absolute precision to safeguard your assets. The ultimate financial insight is that tax minimization isn't about avoiding the system. It's about mastering the precise structural timing of the laws. The wealthy elite don't possess secret rules, they just execute their strategies with flawless timing and absolute urgency. By combining a maximized concessional cap with catch-up contributions and avoiding transaction delays, you can completely alter your financial trajectory. It's about taking full ownership of your institutional wealth and refusing to let administrative errors bleed your hard-earned dollars away. Every single day you delay is a day you're giving up control to the state. If you're ready to stop letting your hard-earned wealth bleed out to the tax office, you need to prepare for what's coming next. In our upcoming episode this Thursday at 7 p.m., we're going to expose the hidden asset allocation mistakes that cost Australians over $45 and estimated $200,000 in retirement growth. You can't afford to miss it. Make sure you click that button and subscribe to Aussie Super Secrets right now, so you never miss another institutional wealth blueprint. Stay urgent, stay smart, and protect your capital. Disclaimer: the information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account personal objectives, financial situation, or needs. Before acting on any information, it is recommended to consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. 2026 Aussie Super Secrets. All rights reserved.